Good morning, good afternoon, or good evening, whenever you're watching or listening to this, and welcome to Link Up Leaders, your direct link to leaders in supply chain and e-commerce. My name is Lisa Kinski. I'm your producer and co-host, and joined as always by Francois Jeffrey. Francois, before you try to talk, you are muted, and I can't unmute you.
I unmuted myself. Are we good to go?
Yes, you were good. How are you?
I'm doing well, a lot better than a few days ago, but doing a lot better today. And let me tell you something. Liquid IV is the truth. I went and picked that up yesterday. One of the best things ever. You actually feel, so I started drinking it, drank it yesterday night, drank it this morning, and it just felt like it was exponentially better.
Okay.
After a rough weekend.
So I had a sample liquid IV that I drank while I had COVID. So I couldn't tell if it made any kind of difference or not, because I don't think anything helps when you have COVID. So I kind of wish I hadn't wasted on that, but I was like, oh, electrolytes. But good. That's good. Did you buy a pack of it or?
Yeah, I'll give you one after this.
Okay. Thank you.
Yeah, we'll try it out. How are you though?
I'm good. I started panicking a little bit because it wouldn't let me go live. I would hit the go live and it was spinning and spinning and spinning. So for those watching us live on either Facebook, LinkedIn, or YouTube, so sorry for just that long shot of the thumbnail. But we're here now, and I didn't hit the wrong. I didn't fuck up the intro this time. We're back on track. Well, let me tell you, StreamYard made some updates. So before, you couldn't delete any of the stock backgrounds or timers that they gave you. They were locked in. They've made a couple of changes to their platform. So I noticed a couple of days ago I could delete them. So I did, because we are not using those anymore.
Not doing those again.
Get out of there.
Paul spent too much time making these nice.
Yes. Awesome. Well, let's go on ahead and jump into today's conversation. We have a rather impressive guest today, and I think this is maybe his first podcast. I don't know. We didn't get a chance to ask before we went live, but let's find out. Today we are speaking with Juan Ignacio Garcia with Boopos. Should we just call you Juan or Juan Ignacio?
Juan is fine.
Juan, how are you doing?
Fine. And yes, it is my first podcast, so please apologies if I screw it.
Hey, no worries.
There's no way.
Thrilled to be your first one, and it's the most laid back show.
We keep cutting each other off.
I know.
So as you can see, we're not even that good at this. No, we saw you on stage when you were with Cabify, and very impressive. I mean, you have an insanely impressive background in finance. It's almost 2 decades, right?
Yeah, actually, I spent almost 20 years working in finance, in private equity, investment banking. And then for the last 8 years, I was the CFO of a company called Cabify, which was it is a startup. Well, it was a startup. Now it's more like a $1 billion company. We raised $500 million US in funding. So super exciting experience.
Wow. And that's like the Spain version of US Uber, right? It's ride sharing through an app kind of a thing.
Exactly. Spain and Latin America.
Gotcha. Very, very cool. Well, and how did you end up finding your way into this kind of e-commerce world, through Boopos?
So it's actually an interesting story. I mean, back in the day when I was ending college, I started doing some work related to machine learning applied to investment decisions. And then over my whole career in finance, I always had this feeling that there was a lot of randomness in the fundraising process. So sometimes it's related to whether you know someone or whether you were inspired at a specific meeting. It could be anything that can just make you hit it or make you just screw it. So when I learned that, around mid-2020, I learned that you had all these people buying businesses based on data that they were pulling through Amazon or through the merchant platforms. I thought it was amazing, and I thought this is exactly what I was looking for the last 15 years. So then I decided to start Boopos, which what we do is basically finance companies based on the data that we can extract from the data sources.
It's a much different background, I feel, than most that we have on the podcast is, but it seems like it would directly apply. I feel like a lot of the same principles would carry over even from Cabify. For example, the presentation that you had on customer experience. When you were talking about that, I think a lot of it still applies just in a digital world. Now, prior to that, did you take any courses? Did you, I guess, meet with anyone to actually learn more about the different e-commerce marketplaces, platforms? And are you in Spain right now?
Yes, I am. Yeah.
Okay.
Yeah, I mean, I explored this specific space for the last, I would say, 1 year. I have very, very good friends at Amazon, at the marketplace, and it's an amazing world. It's huge. You got a lot of people investing their time and their know-how in making sure that all these businesses can grow and that the marketplace grows well. That it's a super exciting universe.
And so when we talk e-commerce, are we talking just Amazon, or are we talking, global marketplaces or any other marketplace? There's, Cdiscount, there's OnBuy, I think is another one. But then in the US, obviously we have Shopify, we have Walmart that's emerging, we have Target that opened up for a little bit. So are we talking every marketplace across the board and platform?
Yeah, actually, I mean, what's interesting about the Amazon universe is that it's very transparent. So you can pull the information directly from Amazon because they have this super powerful API that you can just learn about the products and see their competitive position and how they're selling and everything. So that's what we like about the Amazon universe. But definitely, we're not closed to only financing Amazon businesses. We do a lot of Shopify. The analysis is a little bit more complex because we have to cross it with traffic data, keyword research data. So it's a little bit more complex. But I would say that we like Amazon businesses because we can give an answer or whether we're financing it or not much faster and much easier than other type of businesses that are definitely within the scope. But yeah, preference is Amazon.
Gotcha.
And then for finance, is it finance for inventory? Is it finance for operations? I guess, does it even matter what the financing is for?
That's a very interesting question. You have quite a few platforms funding working capital, financing marketing, in general, financing the short-term needs of Amazon sellers or e-commerce businesses, but you don't have so many funding businesses with a long-term perspective. So let's say that you have to open a new warehouse or launch a new category or a new product or expand to other countries. That's the kind of investment that is kind of transformational when you need a bigger amount and a longer term. And that's the type of financing that we specialize. Even acquisition of companies. Actually, a big part of the loans that we originate are related to acquiring companies.
Okay. So you guys are in.
Oh, go ahead.
We always do this. We always preface with letting our guests know that we might cut them off that there's a delay, but it's always the two of us. Always us.
Go ahead.
So you guys are in the space of helping e-commerce businesses finance, like from the beginning to scale up, and then also helping aggregate or acquire others. Are you also helping them maybe get acquired by larger aggregators as well?
But basically, we're in the middle of the transaction talking about acquisitions. We finance the acquisition, so it's usually the buyer we're helping with. So they say that they're buying a business that is worth $1 million US. We can finance 700K, and then the buyer can just use their own equity for financing the other 300K. So it's usually the buyer we work with, but in many occasions we've seen the sellers sending us the information about the businesses so we can take a look at it and we can provide a term sheet so any potential buyer can benefit from that financing. So I guess that we're also working in very, very strong communication with business brokers, which are in between these type of transactions. So in the end, yeah, we're kind of helping transactions and helping deals happen in a sense.
Gotcha.
And why would a business start to acquire other smaller businesses? And in a more traditional sense, in standard retail or in SaaS, I think I understand that a little bit more. But in the e-commerce space, I think that's something that is newer. I guess businesses are growing to a level to where they see these opportunities to, instead of grow, it's just buy and just take over their operations. But what are some of the main reasons that you're seeing that they're acquiring smaller businesses?
I mean, to be fair, there's a lot of people investing a lot of effort and a lot of time these days in roll-up strategies. So it's not exactly like one buyer thinking strategically whether I should enter with this niche or the other, but it's more like people wanting to be their own Thrasio and buying a portfolio of brands that they can manage together and use their structure to and use their know-how to manage a number of different brands. So it's more of a strategic kind of thing, what we're seeing right now in the market, that people believe there's a lot of value to be created by acquiring a number of brands and putting them together and managing them together.
And what does someone have to prepare to even start to consider that and even to approach you, I guess, as a potential client of yours?
The key here is, as a buyer, you have to be very, very strong in managing businesses. So you have to be very strong operationally. You have to be very committed to the business. Essentially, we just provide the money, which is probably a commodity if you think of it. It's not exactly a commodity because we are specialized in this type of transaction. But the management experience is vital to making sure that the brand that they're acquiring is successful. So as part of the vetting process for buyers, we do a lot of emphasis in how they manage brands in the past and how they're going to apply their past experience in managing the business that they're acquiring. That's the key factor.
Okay. So it's more so, I guess this is leveraging more of an importance on leadership and experience than it is on like good product selection or any one specialty that a lot of times we've seen, a lot of Amazon sellers want to just hone in on just, let's say, their PPC specialty, but they're not very strong in sourcing, or they might not be strong in logistics, but they have a great supplier, but they don't know how to get it to Amazon. I guess what size business should even be considering this when it comes to like leadership and making sure they have that right management experience and operations?
I mean, we're seeing a lot of very, very strong operational people that are managing a small number of small brands. So actually, we're lending at this stage, we're lending between $100K and $1 million US. So that's the type of business that you would expect to acquire with us. And the people that are working with us are very professional. They're obviously they don't have a super big structure like Thrasio, and it's usually a group of 2 to 5 people. But we're seeing people with super strong backgrounds, probably mixed backgrounds between consulting, finance, and e-commerce, and they're being very successful in what they're doing. So,
what do they have to prepare though? Let's say they want to approach you. Obviously, looking at their operations, looking at their SOPs, their P&Ls. But where have you seen some companies maybe, the conversation just goes, hey, maybe start to do this, and then we can talk about the financing again?
I mean, our underwriting process is super simple. A key component of it is what we said before, the management experience of the buyers and the team and the plans. But they need to have a very, very strong knowledge of the brand that they're acquiring. Because we're going to talk about that. It's a very easy online process, actually, that in terms of documentation, they can just send us the P&L for the last 24 months, plus some info on the SKUs that they're selling. And in terms of analytics and so on, we're very quick. But what's important is more the conversation itself, right? Like making sure that we're going to be partners, so we're going to be in it together, and we have to understand or make sure that we agree on the same goal of growing the company going forward, right?
Mm-hmm. And in addition to showing some of that historical data, like you said, their P&Ls for the last, I think you said 24 months, do they need to provide, or should a business provide any kind of plans of like, this is the new products that we're looking to expand into, or a new brand that we want to launch whenever they are looking for that financing?
We like to hear what the plans are. We don't get too much into analyzing that. I mean, we if they're good managers and they've been managing other brands, it's okay. I mean, we just follow the plans. Our underwriting model is more reliant on revenue recurrence, on how well positioned the products are within the marketplace, and how solid those sales are. We like to, I would say, give most of the upside to the buyer, to the equity partner as such. So it's more of making sure that they have a plan, that they're going to execute against that plan, but it's not on us to decide whether we like that plan so much or they should be doing something else.
Gotcha. Okay.
And then does that financing come with any additional resources? So, if you're going to VCs, for example, typically if they're really strong in supply chain, they may have some additional companies they might suggest to you, or partners that they might suggest to you. Is that something that you also provide at Boopos?
We do. We actually, we're a lender. We're not an equity partner. So in the end, the value added that we give our borrowers is more related to the fact that we are finance experts. So we can just help them grow and help them make reasonable financial forecasts over time. Our platform gives them some insights on how to or how the business is evolving and how the evaluation is evolving and this kind of thing. From time to time, they ask us, because we're finance experts in specific topics, we can help them. But we're not a VC. We're not going to make them intros to this and that partners that may help them.
Okay.
That's what Nick Pinev is for, those introductions.
Very good point. Now, outside of that, as you start to see them grow, I guess, what is the process with the payback on these loans?
So we get repaid by taking a cut on their revenues. We take a royalty each month. So given that we're connected to their merchant accounts, we see how much revenue they made each month, and then we collect automatically every 10th of the month a percentage of those revenues. And this carries on over time until we get a multiple of the money that we lent in the beginning. And this is something interesting too. Let's say that over the course of the years, maybe in 1 or 2 years, they were able to find bank debt, which is usually cheaper. We're an alternative lender and we're more expensive than banks. That's fine. We will just give them a discount. They can prepay, and we will just move on to another deal. So that's something that many of the buyers are valuing a lot, because they expect to grow fast and be able to access cheaper financing over time. We won't get in the way in that sense.
Well, banks are still learning a lot about this, right? We were talking to we had a podcast a while back with Chris Schifferling from Global Wired Advisors, and he was talking a lot about how private equity is just starting to really get more into this. And with your background, especially in private equity, where do you see that going when it comes to equity partners and investments versus lenders?
Well, we've seen private equity investors investing in big deals, as well as banks. We've seen banks financing Thrasio. We've seen very recently Bain Capital acquiring Berlin Brands Group. So it's more of a trend of investors that are willing to deploy 100, 200, maybe $500 million US in one deal. We haven't seen so many private equity type investors investing in smaller players or aggregators. That's more VCs or even people bootstrapping and using family offices or people they know.
That makes sense. I mean, it's all associated with risk, right? And they're always going to be looking at the lowest risk. And that's why also it is going to cost a little bit more to borrow money versus, having an investor in the company itself. Now, as they grow, is it possible for them to, I guess, refinance any of their loans?
Yeah, as I said before, if they were able to find cheaper financing, we're happy with that. They can refinance. If they need additional financing in the sense that they are growing quite fast and they need inventory and so on, we can do follow-on financings for that. So it's our deals, our loans are not like a closed bucket that they have to just have for the next 4 years. We can adapt to the new circumstances of the company.
Okay. Yeah, no, I mean, that makes us, especially with, I think, a lot of businesses not necessarily getting off of Amazon, but starting to go more omni-channel and global, right? Seeing new opportunities in different markets, maybe seeing different brands that they could acquire in those markets to expand the product lines into. And so I guess what advice as they are growing would you have to those strong operational leaders when it comes to utilizing the finance? Because I do feel like a lot of them, as great as they may be at the operations and at management, it's still scary, right? Getting a large loan and having to spend the money, right, to make all the money back. What advice would you have for them?
I mean, I think it's the right time to being ambitious. You have a lot of opportunities out there in the market, and probably the bigger brands are selling at higher multiples, but you still can find a lot of very good opportunities at a smaller scale with multiples that are lower. So I guess that if you see that as an opportunity, I would say to a manager, if you see an opportunity, then take it, because it might not happen again in the future. And financing is something that you'll eventually get to if you have a good business, because there's a lot of liquidity out there in the market. There's a lot of money. So I would invite anyone who wants to be or who wants to build a big company and roll up and so on, to be kind of ambitious at this stage, because it might not happen again in the next couple of years.
Yeah, big risk, big opportunities. Obviously, especially in today's environment, we've seen in the past 2 years e-commerce boom a ton. I mean, to say the least. But I think, and these are some other conversations that we've had, is that we may start to see a slowdown, a general slowdown within e-commerce because it has grown so high. What are you starting to see on your side? Especially being so deep into analytics.
No, I mean, obviously, there was like a huge leap forward related to the COVID pandemic and so on. So that's something that the good news is that that kind of leap forward has consolidated. So the businesses are not just going down, but obviously the growth is low, and we can't expect the businesses to grow forever 100% year on year, right? Still, we're seeing very healthy growth in specific brands. So it's probably not doubling year on year, but growing 10, 20%, depending on the specific product. I guess that you have to be selective. Obviously, you want to make much money buying a mask company these days. But if you select the right products and choose wisely and don't overpay, I guess that there's still opportunities of growing. And overall, this year is going to be more transitional. It's going to be, the overall market from our perspective, or what we're seeing, is growing more like 5-10% as a whole. But that's a mix of brands growing quite fast and some others just going down and some others being flat. So in the end, you have a volatility, and you have opportunities to select targets that are growing above average.
Yeah, I mean, I guess access to capital was one of the largest struggles in the past 2 years when you did have those opportunities, especially, right? Not having inventory, not having the capital to just front, well, nowadays it's 5-6 times whatever containers used to cost. But at that time, even it was 3 times. And you were like, I'm not going to shell out $10,000 for a container I was just paying $3,000 for less inventory too, because manufacturers were shut down. To that point, though, what sort of analysis, if any, do you do on their supply chain?
Yeah, that's a very interesting question. I mean, you've seen people working in the e-commerce space for the last 20 years, and it was like I would say it wasn't as glamorous as it is today because it's all the hype with all these people rolling up businesses and everyone trying to start their own brand. And that's good on one hand because obviously it gives you a lot of visibility, a lot of liquidity has poured into the market. It obviously has bad things because some bottlenecks have appeared. Supply chain has been terrible for the last year, and I guess it's a key component of e-commerce. Being able to source the products correctly and being able to have the right logistics in place is vital. And we've seen, brands going really down under when because of all these supply chain disruptions, and some others doing pretty well because they forecasted well, because they had stock at FBA or whatever warehouse they had, and they didn't have so many stockouts. So,
but to that point, when they are speaking with you, do they need to have anything prepared on the supply chain side? I guess to just let you know, hey, we will have the inventory to actually sell in order to pay you back, especially.
I mean, we look at how they historically manage their inventory and whether there have been stockouts or not. And at the time of closing, we make sure that there's an inventory so that there won't be disruptions. Also, we make sure that there's like this migration period or transitional period where they can, when someone's buying a business, obviously you need like 3-6 months to get your hand on it, and the seller involvement is super important. So that's the kind of things that we make sure that will happen. And I guess that the best way to make sure that will happen is to work with buyers and operators that are experienced and that they know what they're doing.
Yeah. Yeah. I mean, knowing how to hire is definitely important. And that does seem to be definitely a growing industry to hire within, but it's not established in the sense that, we've had HR and talent acquisition for tons of different industries, but not so much for the operations within e-commerce too much, right? Like when you go onto any of these sites, Indeed.com, you're starting to see more within e-commerce, but I feel like those are still positions that need to start to grow out. In regards to the HR, and obviously, they do have to be the right managers to manage them. Do you see that any opportunities for companies to I guess hire better globally, since you are, I mean, a lot of these brands are planning to expand out no matter what. US is a huge market, granted, but I think that the next move for any brand is to find new markets. Do you see any opportunities for them to hire effectively globally?
Absolutely. Actually, many of the e-commerce businesses are super virtual or super online. So we've seen people working from India and managing a whole brand that sells in the US and in Europe and these kind of things. There's a whole community of Israeli people managing Amazon businesses, which is amazing from their living room. So I guess that there's a pool of talent out there that there are two things that help people hire the right people for this business. One of them is e-commerce is all the rage now, and a lot of people that ignored e-commerce because it wasn't so glamorous in the past are not just trying to learn more and more. And the second one is obviously remote work is a thing now, and everyone is willing to work on an interesting project, even if it's online. So yes, there's a very, very good moment for hiring good people at this stage.
Yeah, and not only are more people willing to work remotely, I think everybody has kind of more greater ability to do so, because some folks, they either didn't have the equipment or, whatever the case may be. Certain businesses didn't have their, phone trees set up to go to everybody's cell phones, and now with all this VoIP and everything that exists, like pretty much anybody, unless you work in a warehouse or are, a nurse, you can pretty much do your job from anywhere. So that's definitely been an interesting shift, I think, in the last, I don't know how many years. I just listen to these conversations and I think back to like, my dad saying like the cell phones that we have, they're like, the shit's just magic. It is absolute magic. I want to go back 30 years and be like, can you believe that you're going to sell things from a computer in your home anywhere in the world? And it's like, no, there's no way anybody would have thought this would come.
Totally. But what's interesting about the e-commerce space is that many people in the space are already used to working from home because they've been doing that for the last 20 years. So you got a lot of people that started a small brand in their apartment, taking all the goods in their bedroom and then just sending them away. So I guess it's more common. And now that there's more visibility on the e-commerce sector, and this is also happening, you can attract a lot of people that were not willing to do this type of job in the past to this sector.
Very true. Okay. So an interesting question, but I know it's a question that a lot of businesses that are planning to take out any loans to expand would have. And that's sort of what happens if they can't pay you back. What happens if Amazon, let's say, knocks out their account, especially borrowing your money. I'm guessing you're not showing up and breaking their knees. So what happens there?
So, I mean, one of the good things about the financing is that we offer royalty-based financing, which means that if sales grow, then you will repay faster. But at the same time, if sales slow down or even go down, you have to repay less. So it's kind of harder to default on our loans. We have, I would say, embedded flexibility within our financing structures. That's a good thing. Nevertheless, obviously, there are scenarios like you said, Amazon suspending your account and you not generating sales at all, or not generating enough cash flow because you're incurring losses, and many things can happen. Obviously, many things can happen. So what happens there? Well, the first obvious thing we have to do is find a solution and negotiate a solution, and that's the first approach. So we typically would adapt our royalty structure to reflect the new conditions of the company that we have financed. And if that doesn't work, then we have collateral over the business that we are financing. And we will work with the business owner to sell the business and be able to recover a portion of the loan, at least. That will be like a very worst case scenario, if you think of it. It shouldn't happen in many scenarios, even in companies that are not performing so well.
Yeah, and I mean that's not to be a pessimist, but I think that is just to
I think it's being a realist, because that happens.
Well, that happens.
It happens to where they might knock out some of their hero listings, or they may limit. Let's say they change IPI, the way IPI is calculated, and completely screws them over. In any case, right? It's like, what would happen? And that itself, I have student loans, so I see that as more of like an income-based repayment, right? Where they are willing to work with you. There aren't too many lenders out there that are willing or happy even to do it. But it's nice to know that you do have a partner on the other side. That's not just going to send you harassing emails of, hey, where's my money? It's, hey, how can we work this all out together? And I'm a big advocate for just having strong partners within, first of all, your business, but just the entire e-commerce space. That is sort of the next level of maturity I'm hoping to see. And we are starting to see more people using softwares, more people using, not just a single sourcing agent, but let's say sourcing companies like ours, Noviland, using partnered 3PLs rather than just shipping it out of their garages, right? I mean, these are all very important. And these are things that I think you need the proper financing to be able to do. Now, having said that, I guess what sort of multiples are they typically seeing from the financing that they're getting from you in these from what I saw, it's like a 1 to 5 year loan, right? Is that something that you work out prior and sort of have these different check-in goals that you would establish with them?
Yeah, we ask buyers that are buying a company to share with us the structure, the valuation of the company that they're buying, and see how much they're paying. And we tend to finance between 50 and 80% of the business that they're acquiring. So that typically translates, most of the businesses that we've seen are sold between 3 and 5 times profit. So that means that we would finance between 2 and 3, even 4 times in some occasions, the profit of the business. Now that means that it's obviously a big loan, and then you need time for repaying it. So it usually gets repaid throughout the course of 4 to 5 years.
Okay. But like throughout that, are there different checkpoints that they would check in? Oh, I guess how does the entire process work? Do they just submit a form on your website and then you start from there?
Yeah, we have. That's exactly how it works. If you just take a look at our website, you have a form there. You fill the form, and then that form takes you to an app. So that app is a very simple 6-step application process where you enter, the P&L for the last 24 months, an offer letter if you have it. If you have access to the seller's merchant accounts, then that's something that is also helpful if you can share that access with us. And after that process, we will need 48 hours to analyze all the data, and then we schedule a call with the applicant, with the potential buyer. So that call has 2 purposes. One of them is to vet the buyer and make sure that they have the right experience, and as we said before. And the second one is usually by the time of that call, if everything went well, we usually provide the indicative terms of our financing, which are also sent via a formal term sheet through our app. So it's a very, very simple and lean process. When or once the term sheet is accepted, then we move on to the KYC and due diligence part, which is super standard. Just like any other lender, we ask for shareholders and directors of the company to make sure that to comply with AML regulations, and then we move to the contract, which is essentially an extended version of the term sheet. So no surprises there, super easy, and we can complete the process online. Now, what happens? Usually, an acquisition is a process that goes through highs and lows. So there are changes in the offers. There are sometimes negotiations that make the deal terms change. And we are happy to talk to the buyers throughout the process and make sure that they're comfortable in having us as a partner in every single situation. So that kind of happens offline, and we meet constantly throughout the process.
And what level of automation is there in this? Because I know 2 days is very short, it seems. So how do you acquire and actually analyze all that data within 2 days?
It is. If the data is well, or it fits more or less what we're asking, it's kind of easy because it's a very automated process. We have an underwriting process that is mostly, it has 3 blocks. So it's balance sheet, it is P&L and trends, and the other one is revenue recurrence. Most of that is based on standard ratios that we have. And then in the case of revenue recurrence, we look at the data from the marketplace, and we have to get comfortable with that. But I would say it's fully automated. We still obviously we have people looking at it, but we can pull a report in a couple of hours, and then the rest of the process is more of deciding on that set of information and making sure that everything is right, rather than just crunching numbers on a spreadsheet or these kind of things that usually happen when you're applying for a loan at a bank.
And then with all of these term sheets and contracts, is that something that typically particularly an e-commerce business owner would be able to read over themselves, or is that something that would you suggest that they hire a lawyer or have one on staff? Or
it's It's super easy. So basically, the term sheet is anyone can read it and anyone can understand it. Sometimes they have questions and we clarify, but it's 2 pages with 18 points, and they're all very, very, very clear. The contract, we definitely suggest that a lawyer takes a look at it. It's, again, very simple document, very standard lending practices. But given that you're signing a contract where big amount of money is involved, we always suggest that they check with a professional advisor.
And then do they have to have anyone else? I know you mentioned like having the list of the directors and everyone else, but how do they even prepare their team? Or do you have suggestions for how they prepare their team for, starting to acquire more money and being able to essentially just continue growing out all these different operations?
I mean, they usually set the pace. So they're usually the ones that are comfortable acquiring more businesses. And you usually see that if they're not responding, if there's not a clear people at the other end of the line who's always the same and taking control of the acquisition, if the process is a little bit bumpy because they have too much on their plates, it's probably not the right time for acquiring a business. But if they have a very structured team where someone's in charge of the acquisitions, plus they rely on operational people for the due diligence, and the process is very well structured, then that means that they're ready to scale and roll up quite a few businesses.
Yeah, that's it. For someone that particularly might have started this 10 years ago and saw it as a side hustle, maybe they did have those, few dozen units in their apartments. It seems like a very long way in a very, very short amount of time. I mean, we were based in Silicon Valley for a while. And so having those conversations with other businesses that were, seeking, let's say, venture funding, and they had strong backgrounds and experience in acquisitions. It seems like this industry is moving at a pace that it's not scary to think about, but it's how are we going to support it with the infrastructure, right? What are your thoughts when it comes to, let's say, new marketplaces or like global expansion and the ease of it? Do you think any new trends are going to be arising for businesses to start to take opportunities in?
I mean, from my perspective, the Amazon.com space, for example, is massive. And if you only focus on that, then you can make a really, really big business. Nevertheless, there's just so many people out there. And we're seeing a lot of people trying to build strategies based on, I don't know, expanding to Mercado Libre in LATAM or selling in Walmart. That's something that we're also seeing, or having their own D2C sites in Shopify, launching in Europe, sometimes even Africa. We've seen Joomla and Africa being part of the cocktail. So I guess that there's a whole universe out there of people raising money, and we're seeing more and more creative strategies. We've also seen strategies based on sustainability, based on many different things. So yeah, we will see even more creative strategies over time, not just buying businesses and putting them together, but having like a differential kind of way of thinking or way of buying businesses.
Yeah, I mean, it's exciting because supply chain itself is such an antiquated, it's like a dinosaur. Is kind of how I saw it when I first came in 5 years ago. And I mean, we still rely on, let's say a boat gets stuck in the canal, and now there's tens of thousands of containers that just can't get through. We have hurricanes here in the US, and now all of a sudden a lot of product that just can't get across the country, and port congestion is at an all-time high right now. We're seeing shipping costs and containers just also being at an all-time high. That infrastructure itself, I think, I hope, at least with all this money flooding into e-commerce, is going to change. I hope that we are going to start to see more automation. We are going to start to probably see a lot of manufacturing globally change, right? More than just the China model or just the India model, or probably bring it back closer to home. Are you starting to see any brands do that when it comes to just restructuring where they are manufacturing their products?
We've seen that, yeah. I mean, supply chain is definitely a huge bottleneck. We're seeing a lot of people investing in fulfillment. So you have very strong platforms like Deliver and so on, but no one's daring to touch supply chain because it seems just like a too difficult problem to tackle. So yeah, we've seen quite a few brands buying locally, German brands buying German products in Germany, US brands buying US products in the US. It depends on the type of product because the Chinese manufacturers are very competitive. Indian manufacturers are also very competitive. So if you have a differential product that is manufactured in the US and you want to sell it in the US, then I would say that would remove a lot of the pain of buying things because it's much easier to have a local supplier and have it sent directly to your fulfillment warehouse. And a lot of people are betting on that strategy. But I guess that it's not for everyone because if for specific products, it's just not doable. You won't be competitive in terms of pricing.
And that almost makes their model less risky then, right? Because they don't have to take into consideration, boats getting stuck in canals and hurricanes closing down ports and stuff if everything is local. And I have to get this question out because I forgot it earlier and then it came back finally. So in terms of expansion, are businesses that aren't Amazon specific or that aren't one marketplace specific almost seen as a safer bet as far as financing goes? Just thinking back at what Francois was saying about, how IPI changes and if somebody's listing gets shut down and they're not able to pay the loan back, if they kind of have some diversification in their selling portfolio, for lack of a better term, are they almost a safer bet to finance than if they're just Amazon specific on one or two products that may be selling well, but anything happens?
Not really, or not for us. I mean, the way our underwriting process works, we just have to get comfortable that they're very well positioned within the Amazon marketplace. We are very comfortable with the rules of the Amazon marketplace, and we know that they change over time, and sometimes there's kind of this platform risk. But in the end, sellers that do well in Amazon at Amazon have been doing well for many years, and they went through many changes of rules and specifications. So no, we're fine with businesses that are 100% Amazon focused. Nevertheless, we're also happy to see businesses evolving and growing and expanding to other platforms.
I should know if there was maybe some inherent, just inherently less risk in something that maybe has their eggs in different baskets as opposed to putting all of your eggs in one basket kind of a thing, No,
you diversify platform risk, but in the end, that's not a factor for us. We're happy with that. We're comfortable with that, with taking that risk.
Yeah, Amazon's definitely one of the largest platforms, I think globally. I don't know. I'm a little ignorant when it comes to a lot of other countries that Amazon's probably not even within. Like I know Mercado Libre in South America is flipping huge, and there's smaller competitors to it too. Some that we even talk to, and they're awesome. But when it comes down to not owning your clients, right, and not owning, you own some of the data, but it's harder to remarket towards them if Amazon does change their policies. If Amazon, let's say, doesn't allow you, I guess a lot of these have new solutions. If Amazon doesn't allow you to ship into their warehouses, if you have your own warehouses that could do 2-day shipping, then maybe they'll start to, allow you to apply that Prime badge to specific partnered warehouses. Who knows? I forgot completely where I was going with that, with international markets. But ultimately, would you work with anyone that's not specifically on Amazon?
Yes, indeed. We started looking at Amazon businesses because it was so easy to analyze and all the data was just there. But over time, we're growing more comfortable with other marketplaces. And you mentioned Mercado Libre, but there are a number of other marketplaces in Asia too. You have Lazada and Alibaba and so on. So yes, it's something that we will definitely explore.
And have you worked at all with any manufacturer, or I guess factories that are trying to go e-commerce direct?
Not quite. Most of the brands we've looked at don't manufacture their own products. Sometimes they're very, I would say, or they have a very strong relationship with their suppliers, so they are kind of embedded within their own operations, and they have specific products for them, and but not really manufacturers as such.
Okay.
Is that a growing trend? Manufacturers wanting to go e-commerce direct?
I don't know if it's a growing trend. I know it's always been a risk in regards to like what people are scared of, particularly
like internal competition.
That just at their factory is going to want to go direct, and they might just not know operationally how to go direct. But if they had enough financing, they could figure it out. So that's where I was sort of asking those questions. But aside from that, when it comes to company infrastructures, are there any key hires that you're really looking for within their operational team as they grow, particularly as they're talking to you? I know you mentioned directors, you mentioned different operational leaders, but is there any specific leadership positions that you're looking for? I'm sure a CFO would help out.
I think it helps, but it's usually too much of an investment for a small company. If they have, I mean, if the management is financially aware, that would be enough. Now, we like to have very, very strong operational people in the companies that we finance. And I would say that, we talked about the bottleneck that supply chain, purchasing, and sourcing is. And that's, I would say that managing the marketplace, managing marketing and managing sales, where there are a few people that do that, and you have some people that are very, very knowledgeable of that space, but not so many that know the specificities of the products that you are acquiring, and it's kind of a more complex or more specialized part of the business. So we like to have that very well covered.
In the supply chain operational aspects of it?
Supply chain and purchasing, both. So people who have the knowledge of suppliers in China or wherever they source the products, and also people that are in charge of supply chain, so there are no disruptions.
I love that answer, first of all. Being in supply chain for the past 5 years, it's not a conversation I feel that comes up enough in regards to hiring out for supply chain. A lot of business owners, I think, like to keep their suppliers close to their vest. They like to keep those relationships and manage it themselves, which is perfectly fine until you start to scale up. Right? Until you start to have to manage an entire team of, let's say, PPC specialists, of just general, let's say a general marketplace director reports directly to you, and you have 4 of those because you have 4 different marketplaces. And then what time do you have to even speak with your suppliers at the end of the day to continue building that relationship, continue building right forecasts and negotiating better terms and better pricing? Do they have to tell you at all? I don't remember if I saw it on your site, but do they tell you what they're using that money for when they're spending it, or is that something that's at their discretion still?
It's so when it's a growth deal, it's discretionary, so they can use it in whatever they want. But as part of the process, we ask them what the plans are. But I mean, when a company is growing, you usually, so if we would limit that money for using, for example, only in marketing or only in inventory, then we would be just, I mean, it wouldn't do any good to the business that we are financing. We just have to trust them, make sure that they're obviously good managers and they're going to grow the business, and that's why they need this money. But I mean, when you're managing a business, you need flexibility for deploying the funds.
Yeah. Especially if, as you're growing, you have to stay nimble, keep operations lean. But if the new opportunities arise and you have the capital, it's better than not, right? And we've seen that in the past 2 years still. When it comes to the P&Ls and looking at, all their finances for the past 24 months, how much is taken into consideration about, just the big e-commerce boom and that potentially slowing down?
That's part of the analysis. But we don't care so much about revenue growth, but more about profitability and the stability of the sales in the sense that we like businesses that have been around for a while. so more than 2 years ideally. We like businesses that obviously haven't spiked because of the pandemic, and there's a huge risk that it will just go down again. But other than that, I mean, as long as they're healthy in the revenues that they have at this stage, and as long as they have healthy profitability, so they have low tacos and a very good margin on their products, we're happy to finance that type of business.
And since we are reaching the end of the episode, would you mind just giving us kind of a summary of Boopos and where people can find more information, and just quickly also run over maybe like the optimal size business that would be the best fit to work with you guys?
Sure. So we're a lending company that helps e-commerce businesses grow, and that helps buyers acquire Amazon and e-commerce businesses. We lend between $100,000 and $1 million. We're very quick. We can finish our underwriting process in a couple of days and then close the deal in 1 week. We work with a number of aggregators and also smaller players, so anyone can use our financing, and they can find us at www.boopos.com.
Awesome. And that website is on the screen, and it'll be in the description of the video and audio experience, as it always is. Well, Juan, thank you so much for being here today. How was it for your first podcast?
It was pretty good. No, thank you guys. You made it easy. So thank you.
Thanks. I'm actually impressed that this is your first podcast and you already have such a fancy microphone setup.
Yeah, it's a long story, but I used to work in music, and well, I'll tell you this story some other day. But yeah,
we should have started with that. Damn. Well, that's awesome. Well, Juan, thank you so much. And thank you to everybody watching live. And again, even if you're watching the replay or listening on Apple Podcasts, if you liked what you heard today, be sure to give us a thumbs up, comment, share, subscribe, ring the bell for notifications, rate us 5 stars on Apple Podcasts, turn on the automatic downloads. You guys know what to do so that you never miss a conversation with leaders in supply chain and e-commerce, just like Juan Ignacio with Boopos. Juan, thank you again so much.
Thank you, guys.
All right. Everybody have a good one.